Hello, assalamu alaikum. This is JUNAID Khalid. Okay. In this video, we are going to again discuss the adjustments that is related to the consolidation, but this time we are discussing about the consolidated statement of profit and loss. In the last video, in the last lecture, we discussed regarding the adjustment that examiner might ask you or test you for the consolidated statement of financial position. But this time we are having a discussion on the consolidated statement of profit and loss. Now, what adjustment the examiner might ask you? The first adjustment that examiner might ask you, that is related to the intra sales and intra purchases. Now, what entry will be made in this regard? What entry will be made in this regard? That is, the sales will be debited. That is, the sales will be debited and purchases will be credited. And definitely in the consolidated statement of profit and loss, examiner will never give you the amount of purchases. Examiner will always give you the amount of cost of sales. So adjustment will be made in the cost of sales. It means the cost of sales will be eliminated or reduced. Now, what is that adjustment? That adjustment is related to the intra sales and purchases. And remember, intra sales and purchases will always be eliminated at 100%. Will always be eliminated at 100%. It means we need to eliminate, and it's irrespective that whether the parent sold goods to S or S sold goods to P. It doesn't matter. It doesn't matter. Intra sales and purchases will 100% be eliminated in consolidated statement of profit and loss. But now there will be another problem that will arise because of this intra sales and intra purchases, and the another problem is related to the unrealized profit, URP. Unrealized profit will also be eliminated, as we have eliminated in the consolidated statement of financial position. We have to eliminate the unrealized profit from the consolidated P&L. Now, how we are going to eliminate that? How we are going to eliminate that unrealized profit from the consolidated statement of profit and loss? So, adjusting entry would be the cost of sales, or we can say that inventory will be debited. Inventory will be debited and inventory will be credited. Now, what is that cost of sales? We all know that if the subsidiary or the parent company sold goods to another company, for example, subsidiary sold goods to P. Now, that unrealized profit is in the books of a subsidiary company, which means the sales of a subsidiary company. And once we are eliminating the amount of sales, that is the total intra sales, which means the unrealized profit will automatically be eliminated from the sales of a subsidiary company, and now this need to be removed from the inventory of a parent company. Now, we all know that inventory is recorded in income statement as well as in the balance sheet. So we are crediting that inventory of a P company, and that impact will be on the balance sheet side. That impact will be on the balance sheet side. But in order to eliminate the amount of inventory, as we all know that inventory is recorded in the P&L as a nature of revenue. And once we are eliminating, it means now the revenue should be reduced. And in order to reduce the amount of revenue, we will definitely be debiting the inventory account. But if the inventory account is not there, so we'll be debiting the amount of cost of sales. We'll be debiting the account cost of sales. So that need to be remembered. That need to keep in mind that if we are eliminating the unrealized profit, we will not use the subtract sign, we'll use the addition or the plus sign in order to eliminate the amount of URP. So that is the adjustment that will be made out in the consolidated P&L. So this adjustment relates to the unrealized profit. Again, it doesn't matter whether the parent sold goods to S or subsidiary sold goods to parent company. That is the unrealized profit on inventory. So that is the second adjustment that should be adjusted in the consolidated statement of profit and loss. Now, the another adjustment that could be related to the transfer of non-current asset, as we have discussed in the balance sheet, that is the consolidated balance sheet. And now what will be the adjustment? For example, if a parent or subsidiary transferred the non-current asset to another company, now there will be an unrealized profit. We all know that that unrealized profit is also known as the gain on disposal. Obviously speaking, a company must have recorded the gain on disposal in the individual account, and now that gain on disposal needs to be removed from the accounts. That unrealized profit on the transfer of non-current asset should be removed. How it will be removed? Definitely the gain on disposal will be debited. Gain on disposal will be debited. It means consolidated P&L or other income will be debited. Consolidated P&L or the other income line item will be debited, and non-current asset will be credited. Obviously speaking, non-current asset, the impact of non-current asset will be on the balance sheet side, but the gain on disposal will be debited or other income account will be debited. Okay, we all know that whenever we are recording or we are eliminating the unrealized profit or the gain on disposal, we are eliminating the gain on disposal. So definitely there will be another adjustment that needs to be done, that is the excess depreciation. Excess depreciation should also be removed, and excess depreciation will also be adjusted. But remember, excess depreciation for the year. In consolidated statement of financial position, we were having a total depreciation. We were eliminating the total depreciation from the date of transfer. But here we are making a P&L, we are preparing the P&L, and in P&L we know that revenues and expenses are accounted for the year. So excess depreciation will be eliminated. Now how it will be eliminated? We all know that in order to remove the excess depreciation, it means the purchasing company has accounted for the depreciation. Higher depreciation is recorded in the current year. So we need to reduce the amount of depreciation. It means we need to increase the amount of profit. Now the P&L will be credited. P&L will be credited, or we can say that depreciation expense will be credited, and normally depreciation expense is adjusted on the cost of sales side. Normally depreciation expense is recorded in the cost of sales side. So P&L will be credited, or we can say that depreciation expense will be credited, or we can say that cost of sales will be credited, and the other impact will be on the balance sheet side, that is non-current asset will be debited. And definitely if we're discussing about the P&L, so there will be no impact of that debit entry on the P&L side. Okay, so that was the depreciation, excess depreciation adjustment that examiner might ask you in your paper, in your financial reporting paper. Okay, another adjustment that examiner might ask you for, that is the impairment loss. Impairment loss of a goodwill. But again, impairment loss of a goodwill will be recorded for the year. There could be a total accumulated impairment loss from the date of acquisition. But remember, while making consolidated statement of profit and loss, each and every adjustment will be made out for the year. Impairment for the year. Current year impairment will be adjusted, and the accounting entry would be P&L or operating expenses or distribution cost will be debited. P&L or distribution cost or operating cost will be debited, and obviously speaking, goodwill will be credited. So that goodwill will definitely affect the balance sheet side. We are not discussing right now. Okay, another adjustment that examiner might ask you or can test you, that is a fair value adjustment. Remember, fair value, the S company was recording the assets at its book value or the carrying value, but we need to record the assets at its market value or the revalued amount. Obviously, subsidiary company is recording the assets at its carrying value. It means subsidiary company is calculating the lower depreciation. However, as per the fair value, the market value, we need to account for the additional depreciation, that is the fair value depreciation. So another adjustment could be made it out for the fair value depreciation. But remember, this will again be for the year. this will again be depreciation for the year. So what adjustment will be made? Again, the depreciation expense will be debited, or the P&L, or operating cost, or the distribution cost, or most probably and the most relevant line item, that is the cost of sales. Normally the depreciation is charged to cost of sales, so cost of sales will be debited, and the non-current asset of a subsidiary company will be credited. But again, this adjustment will be on the balance sheet side, so we'll not be discussing over here. So that adjustment will be made for the fair value depreciation. Okay, another adjustment that examiner might ask you, that is for the dividend. For example, for instance, if the subsidiary company has paid out the dividend, so the amount of dividend received by the parent company should be eliminated as it is the intra item. So adjustment will be made, that is investment income will be debited. Investment income will be debited. And obviously the retained earning of S company will be credited, as dividends are paid out of the retained earning. But again, that is for the balance sheet side and we will not be discussing over here. So that is the elimination of dividend income from a subsidiary company. One more thing that you need to keep in your mind, for instance, if the parent or acquired a subsidiary in the mid of the year, if the parent company acquired S company or subsidiary company in mid of the year, it means now the line item of a subsidiary company needs to be apportioned on the post acquisition months. But if we are having certain adjustment, there are certain adjustments that also need to be apportioned. For example, excess depreciation. The amount of excess depreciation will be apportioned to the post acquisition month. Reason being, if we are calculating the amount of depreciation, by default that depreciation formula, the straight line formula, will give you a depreciation for the annual depreciation. This need to be apportioned on the post acquisition month. However, unrealized profit need not to be apportioned, as that unrealized profit is already the post acquisition. Intra sales and purchases need not to be apportioned, as these items are by default the post acquisition. And again, impairment loss need not to be apportioned, as the impairment of goodwill is obviously after the date of acquisition. Fair value depreciation, yes, that needs to be apportioned. Dividend income, no need to be apportioned, as the dividend whatever they have received, that is after the date of acquisition. So full amount of dividend will be eliminated from the investment income and the retained earning of a subsidiary company and the balance sheet. So that need to be remembered. Okay, so these were the adjustment. This will be made it out in the consolidated statement of consolidated statement of profit and loss account. Now one more thing, we are eliminating everything at 100%. For example, impairment loss, this is eliminated at 100%. For example, the fair value depreciation and the excess depreciation and the gain on disposal, that is unrealized profit, each and everything is eliminated at 100%. And irrespective whether the P company is sold to S or the S company is sold to P, we are not making any discrimination while eliminating these adjustments. Now the impact will be shown on the NCI working. We all know that once we have calculated the consolidated profit, now the consolidated profit need to be bifurcated into, that is the group retained earning and the NCI. And when we calculate the profit attributable to NCI, what I use the word, that is profit attributable to, profit after tax attributable to NCI. So once we are calculating the NCI, what maximum adjustment could be made out? Let's have a complete working of NCI. What maximum adjustment could be made out? First of all, we'll take this profit of a subsidiary company from the individual financial statement, and we all know that that individual financial statement is unadjusted right now. We have made an adjustment, but that is in the consolidated statement of profit and loss. So far, we have taken this profit from the individual account, and that is the unadjusted profit. We need to have certain adjustment in that particular profit. First of all, we'll make an adjustment for the impairment loss. Now remember that adjustment for the impairment loss of goodwill will only be made out in the NCI if the company is using the fair value method and will eliminate the amount of goodwill. Second adjustment that we need to carry out, that we need to make out, that is the fair value depreciation. That is the depreciation on the revaluation surplus, as company has not recorded in the individual account, depreciation has not recorded in the individual account. So we need to eliminate that depreciation for the subsidiary company's account. Another adjustment that we need to make out, that is the unrealized profit on inventory. Unrealized profit on inventory, but this adjustment will be made out in the NCI if the goods are sold by subsidiary to parent. Another adjustment that examiner might ask you, that is for the unrealized profit on non-current asset. Unrealized profit on the non-current asset, again that gain on disposal will only be adjusted if subsidiary transferred the asset to parent company. Another last adjustment that examiner might ask you for the excess depreciation. Excess depreciation, and this will be adjusted in the working of NCI only if parent sold to subsidiary company, and this will be added back. Reason being, this subsidiary company has already recorded an extra depreciation or the over depreciation. It means now the profit, it means if the subsidiary company has recorded the over depreciation, the profit of a subsidiary company is reduced, or the lower profit is being recorded, so we need to increase the amount of profit. So these are the maximum adjustment that examiner might ask you, and then you need to calculate the total of it. You will apply the percentage of NCI, for example, let's say 20% on that particular amount, and such amount will be recorded in the NCI. One more thing that you need to consider, if there's a mid-year acquisition, so definitely you need to proportionate that profit. You need to proportionate, let's say for the post-acquisition month, that is into 9 divided by 12, and afterwards you will get the answer, and then you will make all of these adjustments. And remember, all of the depreciation like fair value depreciation or the excess depreciation need to be apportioned. Otherwise, impairment loss, unrealized profit, there is no need to apportion, as these are by default the post acquisition adjustment, so there is no need to adjust it out. Okay, so this was the consolidated statement of profit and loss, and we have discussed what maximum adjustment the examiner might ask you from the consolidated P&L question. Now let's move on towards the associate area, and that is relatively a very shorter area, that what sort of adjustment is required, in case of an associate company. So let's discuss with the associate accounting treatment. We all know that for associate we need to apply the equity accounting, and for that we need to calculate two line items, one for the consolidated balance sheet and another for the consolidated P&L. The balance sheet item is investment in associate, and for P&L we have share of profit in associate. Later on we'll say Sophia, that is share of profit in associate, that is Sophia. Okay, now what adjustment examiner might ask you, that is the first adjustment that examiner might ask you, that is for the unrealized profit. Remember, parent and associate, no intra items will be eliminated. In between the parent and associate, the only intra item that will be eliminated is the unrealized profit that we need to eliminate from the accounts of a parent and associate. Now what adjusting entry will be made in this regard? What adjustment? It depends on who sold goods to whom. That is, for example, if there is unrealized profit and parent sold goods to associate company, but remember the share of unrealized profit will be eliminated. For instance, if you have calculated the unrealized profit of 30,000 and you have an acquisition percentage of 20%, it means 30,000 multiplied by 20%, it means 6,000 will be eliminated from the accounts, from the consolidated accounts. Now, how this adjustment will be recorded? The adjusting entry would be the group retained earning will be debited, and investment in associate will be credited. Now, one thing you need to remember, we are making an adjustment and we are right now focusing more on the consolidated statement of financial position right now. That is the adjustment that is specific related to the consolidated statement of financial position. Okay. Another adjustment that examiner might test you for the unrealized profit, if the goods are sold by associate to parent. Now the adjusting entry would be again group retained earning will be debited, and now this time the unrealized profit is in the books of a parent company or inventory of a P company. Inventory of P company will be credited. Okay. Another adjustment that examiner might ask you for, that is the impairment loss of associate company. For example, if the investment in associate is impaired, that is impairment loss of investment in associate. Now, what accounting entry will be made in this regard? That again the group retained, there will be an impact on the group retained earning will be debited, and again investment in A company or the associate company will be credited. Okay. Another adjustment that you need to account for, that is the transfer of post acquisition profit, that is the share of post acquisition profit of associate company. How and what the accounting entry will be recorded? That is the investment in associate will be debited, investment in associate company will be debited, and now the group retained earning will be credited. Okay, another adjustment that we need to account for, that is the adjustment related to dividend. One thing that I will definitely explain you, that is the dividend adjustment. Why there is a need to adjust the dividend? One thing, the IS 28 states that intra items will not be eliminated, but one intra item, that is the unrealized profit, this will never be compromised. You have to eliminate it out because this enhances the manipulation of accounts. So we were about to eliminate the unrealized profit, but why we are eliminating the dividend income? Is because of it, to avoid the duplication. The parent company have already recorded the dividend income in the investment income of a P company. It means the dividend is already recorded in the investment income. Now what we are doing, we are transferring the profit of associate company, that is the share of profit of associate company. For example, if the profit after tax of associate company is 100 million and the percentage of acquisition is 30%, it means we are recording that total 100 million, that means 100 into 30%, that is 30 million profit, and we are transferring that 30 million profit in the consolidated statement of profit and loss. And we all know that associate company were going to pay out of the dividend, pay the dividend out of that profit. And what we did, we recorded that profit, we made that profit a part of the consolidated P&L. So it means we have recorded the total profit, which means the dividend was included. In that profit. So it means there is a duplication. The dividend is already recorded in the investment income of a P company. And on the other hand, we have also recorded the profit of an associate company as part of the consolidated P&L. It means now there will be a duplication. So in order to avoid that duplication, we are making that adjustment. Now what adjustment will be made? That investment income will be debited. investment income will be debited. Investment income will be debited and investment in associate will be credited. Investment in a company or the associate company will be credited. So these are the adjustment that is related to the consolidated balance sheet, and these are the maximum adjustment that examiner might test you in relation to the associate company accounting. Now let's move on towards the adjustment that is related to the consolidated P&L. Consolidated P&L. Okay. Now what adjustment the examiner might ask you for the consolidated P&L with respect to associate company. Okay. If we are asked to prepare the consolidated statement of P&L, so what adjustment the examiner might ask you or can test you, that is the first adjustment, that is the unrealized profit. We have seen the impact of unrealized profit on the consolidated balance sheet. Now let's evaluate the impact of unrealized profit on associate company, because of the associate company, on consolidated statement of profit and loss. Again, this will be dependent that who sold goods to whom. That is, if the unrealized profit is in the scenario of parent sold to associate, now the adjusting entry would be the cost of sales of P company will be debited as the profit in the books of a parent company. Now the profit of a parent company needs to be reduced. In order to reduce the profit, we increase the amount of cost of sales of a parent company. The other adjustment will be on the investment in associate, and this will hit the balance sheet side. This will hit the balance sheet side. Okay. Another adjustment or other scenario, that if the unrealized profit is because of the associate sold goods to P company. Now how this unrealized profit will be eliminated in that scenario or the case? Now the profit will be eliminated from the associate company accounts, and the associate company accounts, how the profit will be eliminated from the associate company accounts? This will be eliminated through share of profit in associate. Share of profit in associate will be debited, and again inventory of P will be credited. Inventory of P company will be credited. Okay. Another adjustment that is related to the impairment loss of investment in associate, and the accounting entry will be made, that is share of profit in associate will be debited and investment in associate will be credited. Again, that investment in associate will hit the balance sheet side, so balance sheet side will be credited. That adjustment is related to the impairment loss of investment. Impairment loss of investment. Okay. Another adjustment that examiner might ask you for, again, the dividend, and we just discussed the entry of dividend. Same entry will be made, that is investment income of P company will be debited, means reduced, and again the investment in associate or A company will be credited. Again, this impact will be on the balance sheet side. So that is the adjustment for the dividend income. For the dividend income which we have received from the associate company. So that is the adjustment which is related to the consolidated profit and loss account. One more last thing that I should share with you, that is the working of investment in associate. That what maximum adjustment that examiner might ask you, and what maximum adjustment that should be incorporated for the calculation of investment in associate. So first of all, there will be the investment at cost, that is the investment made by the parent company in associate company. Now further adjustment that should be accounted for is, number one, that is the post acquisition profit. Share of post acquisition profit. Share of post acquisition profit. Share of post acquisition profit of associate. Share of post acquisition profit of associate will be added in the investment value. Another adjustment, that is the impairment loss of associate or investment, not for the goodwill of associate, will be eliminated. Another adjustment, that is the unrealized profit, but remember, the unrealized profit will only be eliminated if parent sold goods to associate company. And the last adjustment that could be accounted for in the working of investment and associate, that is the dividend received from associate company will also be eliminated. And afterward, the net answer, that is the investment in associate will be accounted for in the consolidated statement of financial position. Okay, another working that I should share with you, that is the working related to the share of profit in associate. Share of profit in associate, for which I will say Sophia. Share of profit in associate. So what maximum adjustment we need to account for, or to how to calculate the share of profit in associate? First of all, we'll take the again share of profit after tax of associate company. Share of, it means if we have an acquisition of 35%, we'll take the 35% of it, that is the profit after tax of associate company. And then only two adjustments will be made out in this working. Number one, for the unrealized profit, but this will be adjusted if the associate sold goods to parent company, this will be adjusted. But remember, the share of unrealized profit will be adjusted. Second adjustment, that is the impairment loss of investment, not of goodwill. Impairment loss of investment that is related to the associate company will also be eliminated, and afterwards you will have an answer, and this will be recorded as a separate line item in the statement of profit and loss, consolidated statement of profit and loss, with the line item of share of profit in associate, and sometimes it's known as what? Income from associate. Income from associate. So that was all the major adjustments or the maximum adjustments that examiner might ask you with respect to the consolidated statement of financial position, consolidated statement of profit and loss account, and with respect to associate company accounting. So you need to memorize all of these adjustments. Please have a review of it. Must remember all of these adjustments. And again, my advice is, once you are calculating or you are performing the working, once you are countered with any of the adjustment, make an entry of it. Entries are the best tools to memorize the adjustments, to memorize all of these accounting entries and accounting adjustment that should be recorded in the consolidated statement of financial position or the consolidated statement of profit and loss account. That's all from this video. Thank you so much. I hope this video is quite useful for you, and take care. Allah Hafiz.